Thank you all. This will be our discussions for cash payables and liquidity management, also known as working capital management part 2, or we can view this as that. This will be part 1 or part A of our respective chapter for the discussions. Let's begin. For this topic, we'll begin with cash management, which would talk about the 3 important points: collection, concentration, and disbursement of funds. So the plus, the collection, and then the grouping of such funds, and the minus, which would be the disbursement. Collection or receipt, then disbursement or payment. For cash manager, here are the responsibilities: how to manage cash, building financial relationships with banks, because we are going to get as many sources as possible for the financing of company with interests, of course. Also with the forecasting, when are we going to have our cash flows, for example, the inflows or the collections or receipts to be received by the company, and when would be the minuses or disbursements or deductions. So we forecast about such. Next would be the investing. What would be the opportunities of the company to place monies and then get investment returns in the form of dividends, for examples, for stocks, or for bonds, the interests. Then for borrowing, so in relation to the second item or responsibility about financial relationships with banks, so where are we going to get monies? Then next is development and maintenance of information systems for cash management, especially for big companies who are already or that are already having their respective information systems being utilized in their operations. So such systems can be used to properly manage the cash. And if it is already existing, then the concern would be to develop such, to be able to sustain and maintain not only in the long term, but also, of course, prior to the long term, short term. Then another important point or term that we should know involving cash management is float. Float basically is fund or funds that have been sent by the payer, but not yet usable funds to the company. Payer, this is US setting or setup, especially our source. But then for Philippine setting, we are using payor. So what is good in normal terms, or like the words with ER or OR in English, and especially with the law and business practice, is that such words ending with ER or OR normally is the doer of the action. So if we say payer or payer, then that is the entity that pays. So again, a payer or payer is the entity that pays something. So if the payer or payer would pay to the company that receives the amount is called the payee. So the payee, the company cannot yet use the funds. So basically that's the float. Payment has been sent, but not yet usable. We can also connect this with our favorite float drinks, if we would like to think about that. Like, for example, our Coke float or any other soft drinks float in Jollibee, for example, or McDonald's. So the float is on the top, something that is there on the top, but not necessarily that we can drink such right away or use that right away. So that's also the case of the float in financial management. We need more time for the float to be mixed to our usable funds or to our drinks so that we can drink them together with the liquid at the bottom. All right. Next would be continuation of float. So in traditional world, this may not be true nowadays, but let us assume there is such thing as mail float. So the moment that the payer or payer would be sending the money, then that is the time as expected from the payment, and then payment is placed on the mail, literal mail or envelope, and then up to the time that payment is received by the entity. That's the mail float. Then this also includes the receipt on the part, for example, of the post office. But what is clear is that this is from the time that the payment has been mailed. Normally checks would be fine because cash would be dangerous. And then that is, of course, up until such time that the receptionist normally and a company or business would be receiving that particular mail. Then when the mail has been received and deposited to the firm's account, it needs time to be processed. For banking practices, I've experienced before that any checks received on or before 11 a.m. can be encashed immediately, but if beyond 11 a.m., then that will be processed in the next day. So something like that. Although in the pandemic times, I've noticed that some banks have extended up to 1 p.m. or it could be more depending on the company's or the bank's capability. That's also another float. The availability float is the time between the deposit of the check and the availability of the funds. And finally, the clearing float is the time between check is deposited and when it comes back to bank on which it was drawn. So basically, the clearing float is now when we make use of the money, but then to be safe, we are using checking account wherein we have the checks to be used for our payments. So without the checks, then no payments will be processed by banks. So these are the four common examples of the floats that we know of. Next would be the cash position management, which would focus again on the daily collection, concentration, and disbursement of funds. So this would also involve if ever there is a surplus, meaning to say there is excess cash, then we go into short-term investing on the sense that we want the money to be available also in the short term. So normally, if we talk about cash and cash equivalents, that should be the banking days of 90 days or less. Although if we say more than 90 days or 3 months to 12 months, that's short term. But if we think about the time that there would be insignificant, immaterial, unsubstantial changes of values of cash and cash equivalents, then that's the banking days of 90 days or less. Then borrowing arrangements, we borrow more money if there's deficit, meaning to say we have shortage of cash. Target cash balance is a cash total that is set for checking accounts to avoid engaging in cash position management. So there is really that particular amount of money that is being set aside there or that is being kept as balance so that such can be usable as we go along the way. Then cash position management as a continuation would involve the following. Smaller companies set targets or target cash balance for their checking accounts. Checking accounts have, again, checks being kept as opposed to savings accounts. Then here's another one. Normally, banks would be providing us bank statements monthly basis, and we can do some analysis about the transactions. Nowadays, since we have online portals and online bank accounts, it would be easier for the company to be able to trace such. Bank provides a report to its customers to show recent activity in firms' accounts. I said a while ago, monthly. Banks cannot pay interest on corporate checking account balances, but it depends nowadays on the type of bank account. There is like a minimum balance for it to be interest bearing. And firms use earnings credit for balances to offset charges. So if we think about it, if on our side as companies, this is discussed, by the way, in financial accounting and reporting, but we can connect. Remember, cash has a normal balance of debit because it is an asset. But on the part of the bank, that's a liability because bank has to manage that cash deposited. So that's a credit. So charges have to be offsetted. On the bank side, charges are on the debit side. All right. So that's also one thing that we should remember about such. But on our case, the charges may depend upon the case or situation. So if that's an expense on our end in accounting, we just have to account that accordingly with our normal balances. Anyway, there will be a minus to cash in bank for such. Then the collection. So primary objective is for us to have a speedy collections. So fast and quick collections, speeding up collections. That's why in the previous topic that we've had, we discussed about the average collection period that should be shortened as much as possible. Then collection systems is a common, or they are common function or functions of all businesses. One of that is FBS, or the field banking system, wherein collections are made over the counter or OTC of the retail, just like if we allow, for example, banks for us to be able to collect speedy. And there are also, for example, pawn shops that are doing this also. We have the service centers. We also have nowadays our apps for that. For banks, we also have our online bank accounts and mobile banking respectively. Or at a collection office, or said a while ago, our Bayad centers, for example. Large retailers use POS, or point of sale information systems, or ISS, to determine the status of the daily payments at the local banks. So even if the payments are not yet reflected, however, there would be details already shown, for example, that certain payments coming from the customers have been made on the banks. But again, there would be processing time normally. Mail-based system, on the other hand, MBS, would be mail payments are processed at companies' collection centers. So we allow our customers to mail their respective payments, and we have our collection centers who will be, or that will be, managing such. For electronic payments, which are being celebrated nowadays, electronic invoices present payment for the B2B market, business to business market. Even with customers, like the second one, B2C, or the B2C, meaning to say the business to consumer market, electronic bills present payment also for such. So again, we do this on the online environment using, for example, our online bank accounts, the version, and also with our mobile banking apps. The advantages would be this would reduce float to the receiving party, so we can minimize. If that's the case, remember, we don't need to mail anymore. So we just have to deal with the processing time. Lower processing costs for both parties. In fact, nowadays, the charges would be free if ever we do, for example, like over the counter with banks. There are no charges to be provided by us, so that our customers would be enticed to pay also, and allow better forecasting for both parties. For the lockbox system, this would speed up collections because it affects all components of load. So lockbox is literally like a box with the lock that we place such there, and then all payments will be placed on certain envelopes and will be placed on that particular lockbox. Customers mail payments to a post office box. That's true. Literally, that's the lockbox. Then any representative of the firm's bank would empty the box, processes such, and deposits each payment into firm's account. Then this would reduce mail and clearing time, of course. So that's another one. Now, for example, if we do the lockbox system and we can shorten the float, so let's do the CBA, or cost benefit analysis. Then our formula would be the net benefit per cost, benefit if positive, and cost would be negative, where this is our formula. FBR is the float value reduction in dollars. Basically, because of the usage of the lockbox system, then we can reduce the float. And let's say it is in dollars, since our source is from US. Then cost of capital, that's our return, R sub A. And then LC is the annual operating cost of the system or lockbox system. By the way, these are dummy variables, so we can replace depending on our choice. However, what is clear is that to get the net benefit or cost to be consistent with benefit positive and cost negative, so we can just think it this way: the benefits minus the costs. So as an example, Reese Industries has $5 billion in annual sales and 8 days of customer collection float. So here as follows, a lockbox system would reduce the float to 5 days. So with that, there is a 3-day reduction. Take note of that. The reduction in float value would be $5 billion multiplied by 3 days over 365 days. So this would be our respective reduction, $41.1 million. Next, we have to take note that Reese's cost of capital, which is R sub A, that's our return, is 13.5%. So the value of reducing customer float, really, so that's our benefit, is 3 days to be incorporated, right? That's $41.1 million from the second bulleted point times 0.135 equals 5.55 or $5.55 million. So that's our FVR times R sub A. So if we analyze, we are going to employ the lockbox system if ever the LC is less than that, because that would result to a net benefit. All right. So if we have a positive result, then we are going to apply the lockbox system. Next, cash concentration is basically bringing the deposits together into one bank. That's the concentration bank. The advantage is that it creates a large pool of funds for short-term investments because it's concentrated in one bank and it's basically in short-term and of course within the 90 days banking days. So it can be available for short-term investments. Then this would improve tracking and control of the firm's cash. It would be easier because there's only one bank. But if we think of so many transactions, that might be another thing now, not necessarily an advantage. Allows the firm to implement efficient payment strategies because we have like one bank being managed for the deposits or collections anyway, but it doesn't mean that we will now abandon our other bank accounts for the payroll or for the payment. So this is just for the deposits or the receipts. The company can now look into ways to be able to minimize the cost, but maximum advantage. That's why we have efficiency here, efficient payment strategies for payments. Next is FTC, or fund transfer mechanisms or check mechanisms. One of that is depository transfer checks. So in this case, unsigned check drawn on one of the firm's bank accounts and deposited in another of the firm's bank accounts. It's like certain or sort of interbank transfer. But these bank accounts are owned, of course, by the company. This is true, especially if we have our, for example, collections or receipts banks, and then we have our bank account intended only for the disbursement for payroll or all other payments. That's another bank account. So we need to transfer funds to fund those bank accounts intended for disbursement or disbursements. Next would be the ATC, debit transfers, automated clearinghouse, wherein it is automated, meaning to say they are basically pre-authorized. There's like a certain amount that is being set already, and the system would generate such particular authorization for electronic withdrawals from the payers or payers account. In this case, they settle accounts among participating banks. We can also apply this in connection with the DTC with pre-authorization. And individual accounts are settled by respective bank balance adjustments. The payer would have a minus while our payee would have a plus. Then with this, transfers clear in one day. Another one would be the wire transfers, in which electronic communications that remove funds from the payer's bank via bookkeeping transfers and deposit the funds in the payee's bank. So basically, the money would be removed from the payer and then it's transferred electronically, deposited to another. However, this would be expensive. That's why it is to be used only for high dollar payments. And this is for US thing. FedWire is the primary wire transfer system in US. Anyway, nowadays, again, we have our respective bank accounts wherein we can do some transfers. But I guess with huge amounts, that's why we do these wire transfers. Otherwise, you will not be allowed. There would only be a limit to certain transfers that can be considered and that can be processed immediately. Now, this is an application of our funds transfer mechanism. So assuming that DG or JM manufacturing needs to transfer $120,000 from its deposit account to its concentration account. Then we have two choices, either to do EDT with a total cost of $1, or we can do a wire transfer with a total cost of $15. Because this would be a midweek transfer, the funds would be accelerated by 1 day using a wire transfer. But then again, the wire transfer is going to be expensive. But anyway, that's why you have $15 versus $1. Now, the firm's opportunity cost for these funds is 7%. Please take note that opportunity cost is the benefit forgone if we choose one alternative over the other. Now, if you look at this, by looking at the two choices, there is a $14 or $14 would be our marginal cost. Remember, in financial management, we analyze at the margin or difference. So to apply our concepts, the value of moving the funds via wire transfer is a marginal benefit equals 1 day of interest. So that's 0.07, the opportunity cost divided by 365 times the $120,000 or dollars. Please take note that this is the formula of computing the interest. That's principal, $120,000, interest of 0.07, and the time, which is in days, actual interest, that's 1/365. So this is like the shortened version of the RT, equals $23.01. The marginal cost is $14, as explained a while ago. Then in this case, the company should use a wire in this case because it would result in a net benefit of $23.01 minus $14, that is $9.01. If we go back to our problem, we are going to use the wire transfer, and then it would accelerate by 1 day if we use it despite the increase of cost. So with that, even if there's an increase of cost of $14 from EDT to wire transfer, but because the marginal benefit is greater than the cost, therefore we apply the wire transfer. All right. And then to determine the minimum transfer amount for which a wire transfer would be beneficial, so we take the differential cost of a wire and divide by the daily interest rate. So that's $14. This is the net cost or differential cost. And then we divide that with the quotient. If we divide 0.07 by 365, so it's like the daily interest rate. So we get $73,000 approximate. So that's our differential cost. And then, which is annualized. If we were transferring funds on a Friday and thus could earn 3 days of interest, the minimum transfer amount would be 1/3 of the standard amount, or $73,000 divided by 3. That's also one thing that we can take note of, 24,333. The assumption here is we can earn interest. So if that's going to be for 3 days, we need to average that for the 3 days to maximize our interest. All right, so that's also one thing that we should take. And please also take note that this is good for 1 day. That's why we divided by 3 to get the daily minimal transfer amount. All right, so this is the end of our part 1. Please stay tuned for the discussions of the next part of this particular chapter or topic involving our cash liquidity, the payables management, and so on. So again, thank you very much and God bless us all. Hopefully you learned something in this particular session.